Jesse Livermore, Lessons from a Legendary Trader. Born in 1877, Jesse Livermore is one of the greatest traders that few people know about. Jesse Livermore was a stock trader that amassed a huge fortune worth $100 million, $1.5 billion in today's money, at his peak in 1929. Livermore liked trading in stocks that were moving in a trend, and he avoided ranging markets. When prices approached a pivotal point, he waited to see how they reacted. Price patterns, combined with volume analysis, were also used to determine if the trade would be kept open. The enormity of his success becomes even more staggering when considering that he traded on his own, using his own funds, his own system, and not trading anyone else's capital in conjunction. Jesse did not have the convenience of modern-day charts to graph his price patterns. Instead, the patterns were simply prices that he kept track of in a ledger. He only liked trading in stocks that were moving in a trend, and he avoided ranging markets. When prices approached a pivotal point, he waited to see how they reacted. For instance, if a stock made a $50 low, bounced up to $60, and was now heading back down to $50, Jesse's rules stipulated waiting until the pivotal point was in play in order to trade. If that same stock moved to $48, he would enter a trade on the short side. If it bounced up off the $50 level, he would enter long at $52, closely watching the $60 level, which is also a pivotal point. A rise above $60 would trigger an addition to the position, pyramiding, at $63, for example. Failure to penetrate or hold above $60 would result in a liquidation of the long positions. The $2 buffer on the breakout in this example is not exact. The buffer will differ based on stock price and volatility. One wants a buffer between actual breakout and entry that allows them to get into the move early but will result in fewer false breakouts. Price patterns, combined with volume analysis, were also used to determine if the trade would be kept open. Some of the criteria Jesse used to determine if he was in the right position were: increased volume on the breakout. The first few days after the break, prices should move in the breakout direction. A normal reaction occurs where prices retrace somewhat against the trend, but volume is lower on retracements than it was in the trending direction. As the normal reaction ends, volume increases once again in the direction of the trend. Deviations from these patterns were warning signals, and if confirmed by price movements back through pivotal points, indicated that exited or unrealized profits should be taken. The trading rules that follow are simple and have been included in many trading plans by many traders since they were created nearly a century ago. They are still valid today, and were created under Jesse's truism: there is nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. Trade with the trend. Buy in a bull market, short in a bear market. Don't trade when there aren't clear opportunities. Trade using the pivotal points. Wait for the market to confirm the opinion before entering. Patience leads to the big money. Let profits run. Close trades that show a loss, good trades generally show profit right away. Trade with a stop, and know it before you enter. Exit trades where the prospect of further profits is remote, the trend is over or waning. Trade the leading stocks in each sector. Trade the strongest stocks in a bull market or the weakest stocks in a bear market. Don't average down a losing position. Don't need a margin call, close the position instead. Don't follow too many stocks. Jesse Livermore made $100 million during the Great Depression because he shorted during the stock market crash of 1929.1.